All right. Welcome back to the Happy Hour podcast. And I am your co-host, Isaiah Douglass, here with my other co-host, Josh Bennett.
Hey, great to be back.
Yeah. So what we're going to talk through and chat on today is actually a couple different videos from TikTok. And I think one of the things that we've noticed is a lot of people will go to TikTok for advice and guidance or see things. And so while I know you're a more prevalent user of TikTok, since I
think addict is the right
since
right
I do not have TikTok, do not get on TikTok, I do follow on Twitter the TikTok investors, which is how I was able to find some of this cringy / funny content. And with that, so we're going to basically review 5 different videos. And so if you're tuning into the podcast, would suggest go over to YouTube and watch this, because what we're going to do is we're going to post the videos as well, and we'll talk through them. So we'll try to get the audio into the podcast as well, but you can actually watch the videos as we go through. So the first one is titled Nothing Like Earning 7.5% per day, and it is the power of compounding, how to turn $1,000 into $1 million in 100 days. So we will play the video.
Is it even possible to turn $1,000 into $1 million? I'm going to show you how not only is it possible, but how you can do it in just 100 days with the power of compounding.
So the video itself is walking through and showing and pulling up basically a calculator online and being like, hey, if you just put in 7.5% per day, this is how quickly you can grow your wealth. And it's like, well, damn, that's easy. Why doesn't everyone do this? And so he kind of leads at the end of saying, well, it's using options. And the idea of using options is not necessarily a bad thing, right? Like, I don't think either of us are opposed to options, but he talks about how people are just greedy and it's easy to get 7.5%. In options. Now, neither of us are options traders where we do this for our day job, but I know there's some people out there that do day trade, that do options. They're not doing anything close to that kind of return per day and win for 100 days in a row. So my guess is that there's a course behind this. I'm just guessing, right? Like, I don't follow this individual, but what are your thoughts on this kind of get rich quick scheme, or lose your $1,000 in 100 days type of strategy?
Yeah, I mean, in full disclosure, it probably is possible, but not probable. Whereas like most options traders, traders in general, only about 4% of traders are actually successful on a consistent basis. Granted, those are the ones that tend to have rules-based trading methodologies and things like that. But I mean, I forget the exact statistic, but even like a good trader only wins like 60% of the time. And when you're dealing with options, it's just massive leverage. So those times that you don't win just count against you and are much more painful. And it can be a zero-sum game with options where it can be all or nothing. So if you have a pool of money that's, let's say you start with $1,000 and you bet wrong the first day, well, you could have zero. And you're
day 2, our balance is now $0.
Yeah.
Thanks for coming.
Yeah. I mean, yeah, could it work? Yeah, maybe.
The odds of you winning that long consistently for 100 days, to me, is a 0. There's no way anyone has done that. To me, it's there can be one massive bet that you make that maybe it could turn that 1,000 into, that number, but to do it consistently like that and win and hold yourself to it, no.
Oh yeah, I mean, I think the 7% per day regularly is complete bullshit.
Yeah,
there's no way.
Yeah,
but could you theoretically go from 1,000 to $1 million in 90 days or whatever they said?
Yeah, it's
100 days.
100 days.
Yeah, I mean that probably is possible, but it's going to be very feast or famine. Like, you're going to have days where you get 100x return, and you're going to have days where you could lose everything.
I think it goes back to like, who is going to consume this content and say, yeah, that's what I need. Like, to me, it's feasting on people that are trying to figure out a way to get out of, a jam, or just invent or find money really quickly that really probably can't afford to do it anyways. It's similar to the approach of like, hey, the people that are buying lottery tickets are the ones that can't afford to buy the lottery tickets. And to me, it's kind of this predatory behavior to advertise or try to sell a course, and maybe he's selling this course for, hey, $15 or $20, right? There's probably some issues with that, but his thing is, who cares, right? Like, if this works and you get enough people to sell it, he makes his and moves on, right? And you do the next thing. So it's it's the accountability piece that drives me a little crazy with advice like that.
And I think what most people don't realize, I think they think this is like just a golden ticket. Hey, follow this strategy and boom, you're done. But to actually be a successful trader, it takes massive amounts of studying, massive amounts of research and understanding. I mean, we've been studying the markets for, multiple decades between the two of us, and I don't think either of us would feel comfortable, betting our life savings or a good chunk of money on trading options on a regular basis.
No way.
Even with all the things we know. And I'd say we're probably near the top of our field when it comes to understanding the markets. Obviously there's going to be more people that know more than us, but, again, for the average Joe that's watching this video, trying to be a consistent day trader out of thin air is going to be impossible. And like a lot of these strategies that they pitch, one of the things that you learn the more you study is that strategies are very fluctuating, because basically a strategy, what may work for a year, once enough people pick up on it, well, it loses the value because people are repeating the strategy, and therefore that you're not gaining anything by having sort of insights in the market.
It's arbed away, right? It gets the efficiency wears out. And also the other thing is, strategy might have worked in 2020 right after, the massive stimulus, quantitative easing, like free money, everything's pumping and moving, and all of a sudden you go in a different environment and like everything this person thinks works does not work anymore. And so it can be very regime dependent, where in this environment, yes, this works and this is great and you should buy this course and do it, but that environment's not going to be around for the next decade, let's say. And so all of a sudden, they may be correct in this environment, this works, but it's no longer the environment that we're in. So that one is troubling to me. Moving on, I'm gonna give you this one because you are kind of the resident tax expert on the show, and it's not a video, but it's like a screenshot of the TikTok, and we'll put it up on the screen for the visual on YouTube. But it says do's and don'ts car edition, and it says don't take out a $40,000 loan for a car, pay $500+ for a car note, as well as car insurance every month for 24 to 96 months. If you're financing a car for 96 months, there's probably affordability challenges there, but we'll step aside on that. That's not the issue with this thing. And then it goes, start an LLC, lease the vehicle under it. It now becomes a business expense, allows you to receive the money back as a write-off on your taxes. Now you can trade it in 3 to 4 years for a new one, rinse and repeat. Why doesn't everyone do this strategy?
Because one, there's lots of reasons. But so basically with the IRS, there's kind of two ways you can write off an automobile expense. But one is that it has to be a 100% justifiable business expense. Like you can't just all of a sudden be like, oh, I have an LLC and now I have this business and I can write off my car entirely. No, it doesn't work that way. You actually have to have a business that relies on your motor vehicle to facilitate it, though. So think of like construction companies. Yeah, they can entirely write off the trucks that, haul the equipment and things like that, because it is a necessary expense. Someone that's working in the e-commerce internet business that, from their home, it's going to be a very hard sell if the IRS comes and audits you that, hey, this is 100%, justifiable business expense. You can write off mileage, which the IRS actually just increased their mileage deduction to like 68 cents, I think is what, if I remember, memory serves. But even if you have a car and write off the lease or write off the expense, the other thing is, like, if it's not 100% business use, you still have to track the mileage, as you can only write off the proportion that is actually used towards business. So say you drive 10,000 miles in a year, 4,000 of it was for business. Well, you can write off 40% of all your expenses, not the full amount. An LLC, this is like a big misnomer, and I see this on TikTok all the time, that people think this LLC is just a magical shield for taxes. It's not. It's complete bullshit. So an LLC, all it does is protect you from liability. Whereas the IRS, especially if you're a single person, a single member LLC is, to the IRS, what's called a disregarded entity, meaning it just doesn't exist for IRS purposes. Everything is you as an individual. So therefore the LLC does nothing.
Yep.
That's my soapbox.
No, it's perfect. I think that addresses that specific one perfectly. So I'm going to go to our next video, which is called The 5 Rules of Wealth. We're not going to do every one cringy because some of these actually are decent. So let me play this next one for us.
Today we're going to talk about the 5 rules of wealth. If you want to grow wealthy, follow these simple steps.
So to kind of recap his video, pay yourself first, compound your money, and then their estimated target of like what they're shooting for is 7%. Protect your investments, which is interesting because they don't necessarily say exactly what that means. Maximize safe leverage and use someone else's money. I think that's an interesting one we can chat on. And then increase your financial knowledge and skills. I actually don't hate this video at all. I think there's some really good stuff in here.
I would absolutely agree. I mean, I think the undertones of this, I would guarantee he's a Universal Life salesperson at the end of the day.
Makes me wonder on 3, but yeah.
But because there's the same verbiage that you see with a lot of kind of the Universal Life sales pitches. But in concept, I mean, the idea of Universal Life and kind of, the big titling for this that you see all over the internet is, build your own bank and things like that, which the idea of it is great in theory. The vehicles that people use often, including Universal Life, can or cannot be beneficial depending on how they're used. And oftentimes I think this is can be sort of predatory. But in terms of this, I think the idea of, we preach this all the time, consistent compounding is really what matters when building wealth, not these, highs and lows of like, hey, I got 30% in this high growth tech stock, but then I lost 70% the next week. So I really like the idea of that he's preaching consistent compounding. I really like the idea of other people's money. A big thing I'm a big proponent of is real estate and buying businesses more so than starting businesses, because basically through the SBA, if you go to buy a business that's has really good cash flow, you can have the SBA pay and the seller pay for 95% of it. So you can buy hundreds of thousands of dollars of cash flow for pennies on the dollar, which I think using that, and that's a real quick way to, quote unquote, safely leverage yourself in your skill set to, double, triple, quadruple your income overnight if you have the hustle to do so. But yeah, what are your thoughts on it?
Yeah, I like the idea of the leverage, because I think leverage usually is used a lot of times in terms when it's a negative, but everyone is highly levered to their home, right? So we use leverage all the time. And so when people take out and buy a home, they say that I bought my first home. It's like, no. You borrowed probably 80, 85, 90% of the money, and then you put a small down payment, and that's using leverage, and everyone's fine with it. And then you use leverage in other spots, like you said, to buy a business, or maybe even to say, hey, I'm going to use an investment account. I'm going to borrow against that, depending on what the investments are, and you need to understand the risk involved. Using some leverage is not a horrible thing. You just need to know it's going to amplify the positives and the negatives. So the ups can be great, and the downs can be obviously much worse, to where you need to be careful with it. But I love the idea of using, again, whatever you want to define as safe, just like the idea of aggressive versus conservative. What does that actually mean? I mean, there's nuance, but it's a 60-second TikTok, so we'll give them a break. The idea of the financial knowledge and skills of kind of being that evergreen learner, I think we talked about that in the first episode of this podcast. I think that's great. And that's the idea that people, everyone doesn't have to do it the same way. You view real estate as something that is really interesting. I view real estate as it's the biggest asset class in the world. And the reason it's been the biggest asset class in the world is some of the tax benefits, and it's something that you can't necessarily trade in and out of, but yeah, you can use leverage on it. But a lot of it's been a store of value that maybe doesn't really justify it in the world I think we're going into. And again, that's a personal opinion on that, but the idea of you can learn and be really good at real estate doesn't mean you have to be really good at, traditional markets. Find what it is that you're interested in, double down, and continue to learn that, and then outsource some of the other stuff. So love that. The compound your money, the 7%, I don't know where he's getting 7%. I would love to kind of dig into that.
That's the what I think is
what's the
universal whole life
what's the
policy.
What's the 7%? And for those that are listening, and we keep referencing this insurance piece, a lot of times with insurance, when they'll kind of pitch these compound your money, use insurance, and tax free, and all these different things, what happens ultimately, and what I've always asked people is, they can run an illustration and show a rate of return that is much higher than what's actually happened. And then all that's really going to go on from there, insurance companies, they have actuaries, they have smart people, then they pool all the money together, and then it's invested. What is it actually invested in the pool? Because yeah, there's going to be some things that they can do that maybe you and I can't, but a lot of it is similar things. And they may use leverage inside of that. But a lot of insurance companies have owned bonds for a lot of years, and bonds have been a place where I think money will go to die for the next 10 years or so. So it'll be interesting to see a lot of these illustrations and a lot of the things that people have projected out from an insurance standpoint. Will they hold true? Because it's all an illustration. It'll say not guaranteed, and then they'll always show it obviously rosier than what it actually ends up being. But yeah, 7% is a nice number, but my question would be, what's the what's the taxes, fees, and inflation? Like, let's talk about real returns, not nominal. And I think he's referring to nominal returns, which is before all that. So yeah, if you can compound your money at 7% real, you're doing awesome. You're kicking ass and taking names. Like, that's great. But if inflation is 5 or 6 and you're making 7, you're not really, compounding that much from there. But what do you think about the idea of the pay yourself first? Because I think this is an interesting one that I think you can make the argument in the case on both sides, where it can be pay yourself first as like reinvest in the business, or pay yourself first as like pull it back out or save it. How do you think about pay yourself first?
I think about it as in sort of investing in yourself, whether it's, say, like, so it's this pay yourself first is commonly used in either businesses, which like the name there I think is like more profit first.
Yep.
But then pay yourself first, as an individual as well, is sort of basically money hits your account from your paycheck, and before you pay your credit card bills or anything else, you automatically siphon off 10-20% to your investments or your future, basically. In concept, I think it's a great idea. The thing I think people need to be careful of is it can, if not used well, if you don't check other things like your lifestyle expenses and things like that, well, doesn't matter if you're investing at 7% compounding, if you're on the back end creating 10% more credit card debt at 20% on an ongoing basis because you aren't cutting your lifestyle. So I think in a nutshell, like, the idea is wonderful, but in execution, it has to be done typically in tandem with some other lifestyle factors as well. Same with the business part. Like, I think, setting aside profits for future investment is a wonderful idea. We're seeing lots of businesses right now that are doing massive layoffs because they didn't do this, where they didn't keep enough cash on hand for the bad times or for investing, being ready to invest in times like now. Like, when you go into a recession, when things get ugly, that's the best time you want to have cash. Where instead companies were investing heavily when things, the music is running wild and everyone's doing good. But setting aside some of those profits to sustain the business, I think, is also a good idea. But again, you don't want to necessarily put the cart before the horse and take profits away before you've gotten your cash flow in check and some other things that we often can see within a business. So you just want to be, either way, you want to be strategic with your cash flow. I think that's super important, whether you're an individual or a business. Going
back to the idea, and this is going to go on a little bit on a tangent, but hey, that's why the podcast is here and we don't have a clock that's running. But like, thinking about, when you talked about layoffs, I was just thinking about Robinhood, because I think that was the one that was just announced recently. It was 23% of their workforce announced over Slack, which is interesting, but they are a good example. In the same way, like when we go back to kind of COVID in 2020 with airlines, right? All they did was buy back their shares, and or they're not incentivized to hold cash because the cash is burning a hole in their pocket, because cash has historically been trash, where you either need to pay it out in dividends, you need to reinvest, you need to do something with it. And so the incentive structure for all the executives is grow the share price. And another really interesting thing is, so like Voyager just announced their bankruptcy, but if you go back and look at the CEO, he cashed out super high last fall at like the high of like multi millions, when I think the stock price was closer to 20, and I think it's sub a penny at the moment. So like, thinking about that, the incentive structure for these people is to come in, make what they can, and then move on, because they're not truly, when I think about like public CEOs, a lot of them don't actually own the company at this point, right? They're just there to make their comp and move on and try to grow it as much as can and like pass it to the next person. It's almost similar to like politics, if you think about it, where it's like, hey, we're here for a while, we're going to do what we can, but we don't actually want to make the hard decisions, right? Like, that's got to be on someone else. That's the next generation. That's the next person coming. And so like, the incentive structure is fundamentally broken, where you can't save and hold cash for a rainy day, because you get punished by capital markets saying, well, you got to do something with this money, instead of being responsible and saying, hey, you know what? Things are good now, but we want to like buckle down and be responsible. And for a lot of companies that want to do that are big, it's hard. Well, but I mean, like Warren Buffett's a good example, where he always gets beat up on for having, Berkshire having a bunch of cash.
Well, and I think actually he's a good example. And I was actually going to mention some of the other kind of owner CEOs that are out there. That's the reason I think they've been massively successful over the past 10, 20 years. Like, you look at the biggest success stories are Warren Buffett, Jeff Bezos, Mark Zuckerberg, Elon Musk. But they basically said, fuck you to conventional like quarterly earnings and things like that. They're like, we're going to do what we want with our cash. We're going to run Amazon at a negative earnings, even though we can start doing dividends.
Mm-hmm.
They basically chose to go against convention, and it's rewarded them handily. So I think there is definitely something to be said for that. And I personally hate this whole like quarterly earnings, because if we're investing for the long term, why do you need to know every quarter? We know from firsthand experience, things do not move that quickly within a quarter, no matter how big or small your company is. Like, it's just impossible to make real tangible differences in 3 months.
Yep. Yeah, I totally agree with that. But again, not a bad video. So TikTok videos aren't all horrible. I'm going to play the next one, which is all around mortgages, 15 or 30 year.
This might be a stupid question, but should I get a 15-year mortgage or a 30-year mortgage? I think the choice is obvious. You pay me off in 15 years and you'll pay way less interest. Wait a second, you should choose me. I offer lower monthly payments, plus you can always pay me off early. Trust me, kid, you don't want debt weighing on you for 30 years. You'll be a grandpa by then. Interest rates are low. Why?
All right, so thoughts on 15 or 30-year mortgages?
This to me is a trick question, because it depends. Right now,
Well, come on, we're supposed to be giving
100
size short clips of like, this is the right answer.
Yeah,
You can't tell me it's great, Josh.
Yeah, they're well, one thing you'll learn is there's always gray area in everything. But like when I think of debt, and this kind of circles back to using debt as a tool, like debt is absolutely a tool if used in a way that makes sense. So for example, like if interest rates are low right now, like interest rates seem high because interest rates have been going up. But that being said, inflation is higher. So even with high interest rates, well, inflation is higher, so you're still paying that debt back with cheaper dollars. So therefore, you actually save money, even though you're spending more money, by having debt longer and paying it off slower. So the 30-year mortgage right now makes a lot more sense than a 15-year mortgage. If those incentive structures reverse, though, and let's say interest rates are at 8% and inflation's at 2%, and it's a personal home where you're not getting any sort of return on equity there, then I would absolutely say pay it off as quickly as possible. Like a 15-year mortgage then would make a lot of sense, and I would actually probably even do 15-year mortgage with extra payments if you could. But the other part of this too is that the best use of your cash? Whereas I view especially personal real estate as an expense. It is not an investment, because I have yet to find the person that the moment they retire, they sell their home and just pocket that cash for investment purposes. So yeah, it's a legacy for your kids generally is like the only way I see it really as an investment. But that being said, if you have the opportunity to take more of your mortgage payment towards investments, so like say you do 30-year and keep your cash flow lower and then reinvest the rest, well then it absolutely could be better to do the 30-year mortgage, just because again you're investing the rest. But in actuality, do most people do that? Not really. They see the extra $2,000 or whatever to their lifestyle, and next thing you know, lifestyle creep happens, and they don't amend and adjust. So that's where, if you have the discipline and things like that, I think a 30-year mortgage most times makes more sense. What are your thoughts?
Yeah, I would say I would be hard pressed to explain why a 15-year mortgage would make more sense. If you run the numbers and think about it logically, you have an asset that historically has gone up. Again, we can argue real estate is in a bubble and it's popping at the moment. So those prices will, correct or change. But historically, you have a fixed rate. So first, make sure that the debt is fixed at that rate. And then you have an asset that's going to accrue in value. Like that payment's going to be less and less with inflation. So you could play on that. And then, take the money and go do something else more productive with it, because it is 100%, like you said, a lifestyle choice. It's not something that is, investment by any stretch of the imagination. So take the 30-year, give yourself the flexibility. And then also, if we do go into hard times and you have a 15-year mortgage, you don't have a lot of wiggle room. At a 30-year, if you wanted to, pay more on it or whatever, and then back off and give yourself, a little bit of room, you could. So I think it gives you more optionality to where there's no prepayment penalty. You can always refinance, you can do different things. But yeah, there are better places to put money than back into your home via mortgage payment, in my opinion.
What are your thoughts on, kind of throwing a curveball here, paying it off in 15 years so you have the kind of independence of not having a household payment, if you will?
So then in 15 years, you're going to save more at that point? Like, what does the cash flow do then in 15 years? Like, are you going to start investing in it?
It gives you more, like, so from a, call it like a work optional standpoint, the lower your expenses are, the less investment pool you need to sustain a life away from work. So if you aggressively, pay off your home and cut down your expenses, then you don't need as big a nest egg to to retire early. What are your thoughts there?
Yeah, so if I put more, so now all the value's in my home versus I didn't save it and invest it, so I still can't retire because I don't have anything, income or any work optionality outside of that. Am I taking a home equity line of credit? Am I doing a reverse mortgage? Like,
well, let's assume you're saving on top of this.
Yeah. So
for example's sake.
So if there's a bunch of cash flow, sure, it can be better. But again, going back to your point, like most times it's an either or. It's not like doing both. Yeah. And so with the 30-year, again, looking at where rates are and where rates probably will be again, I don't think rates are going to stay as high as they've been. So rates will have to come back down, or the asset price has to recorrect. And then from there, what we'll want to do is just think about how do you make this more beneficial longer term. And so, yeah, run the numbers. What's the best use and where are funds, more accessible? Is it more accessible to have funds in your house, or is it more accessible to have funds in, some sort of outside investment? And I would say the optionality would be more so outside of the investments, because you can diversify more if you think about it. If everything is, the wealth is tied all into that home, and that area all of a sudden is not as attractive as it once was 15 years ago, now you have an asset that maybe you've dramatically overpaid. The other thing to think about with homes is even if it's paid off, it's still not technically yours. Property taxes, all these other things, like there's still bills that will come due with all that. So
land of the free. Yeah.
Try not say you own your home and then don't pay your property taxes. See how long it's still yours. That makes no sense to me, but that's a whole other conversation.
Yeah, that's a soapbox we can go on a tangent for a long time on.
So let's go into video number 5, which is 4 things to do for your kids.
4 things you can do to give your kid a jump start in life financially. Number 1, open up a joint checking account.
All right, so he's talking about joint check account and add them as an authorized signer on your credit card, 529 accounts, a custodial account, and a Roth IRA. What are your thoughts on the 4 different things that he kind of outlines with the kids? Because I'm mixed on these.
I'm mixed on some of them as well. The joint account, I think, is a phenomenal idea, especially if you use it as like a, say a depository for, there's, and actually we'll probably do an entire podcast on like things like this for kids, but some of the ideas I've heard over the course of my career, like, for every $1 the kid earns from, working a side job, the parents will deposit $1 into a savings account. So a joint account for something like that, but where you are actively, teaching your kids about investing along the way, like you make them do quarterly reviews with you on how the investments are doing or things like that. Like this is something my grandmother actually did with me, where that's what part of it went into me up in finance, is, I think back in the day she gave, a gift of, I think it was like a big birthday, maybe 13 or something like that, gave me, a couple $1,000s of in some mutual funds, but she made me, even though it was like, I feel bad for the broker that had to sit down with me to do this, but because it was like probably pennies to them at this point, but she made me and my mom sit down like once a quarter and kind of go over how the investments were doing, really understand the functionality, all these different things, and that served me 10 times over, just having that investment knowledge early on. So I think doing that sort of thing with a joint account is a great idea. I think making a kid an authorized signer on a credit card is a wonderful idea if you also teach them responsibility.
That's where I was going to go with it.
I mean, my parents love them. They did this with the right intentions. Me being a idiot, irresponsible 18-year-old also got myself into a lot of credit card debt that became painful later on. So I mean, it can go even for people that know finance, and people make mistakes. So I think that's if there's oversight, I think that can be a really good idea.
What about a debit card versus a credit card? And just having an account where they can still use it, but then there's kind of a cap as far as what they could spend.
Well, most credit cards you can set a cap on, but I actually tend to not be a fan of using a debit card ever, unless it's for an ATM. And the reason for it is just, I used to work at Schwab for a long time, and the amount of fraud I saw from debit cards is just insane. And I'm sure anyone listening here has had their credit card hacked at least once. It's a lot easier to get your money back and things written off of a credit card than it is a debit card. So from that standpoint alone, especially just the modern age we live in where everything's electronic, I'm not a big fan of debit cards. Granted, if it's a kid, you're dealing with like $200, probably not the end of the world, but Yeah, what are your thoughts on it?
I think about the idea of like savings and just thinking about like, oh, we're going to put money into a checking or, savings account for you and hold dollars. To me, it just doesn't make any sense. Like, I'm going to have Bitcoin and stack sats because that's better money. So point blank, like that to me makes a heck of a lot more sense than holding dollars. Cause like what are these dollars going to buy? Like they're not even going to get, a shoelace by the time they're 18 when they use the money. So I don't love the idea of doing that. I think more people will start to adopt that mentality in the future, but it's just trying to save better money that actually retains purchasing power versus lose it. I don't love the idea of the authorized signer on the credit card. Again, even if they're responsible, I don't love that. I don't think they necessarily need it. The 529 account in Indiana, you get a state tax credit. So like if you put in $5,000, you get $1,000 state tax credit. I like a lot of states don't give you anything, and then it kind of have some, strings around how you can use the money. And yes, you can use the money for, private school or other things, but I traditionally don't love 529s for a lot of people. Like Indiana, yes, I think it's a little bit different. You have a little bit more flexibility. So sure, at least do the 5,000. But yeah, I don't love 529s. And then the idea of like the custodial account, again, if you have a kid that is not as responsible when they get older and they hit the age of majority, whether it's 18 or 21 or 25, and they get the money, I don't love that either. I'd rather have a joint account and then just be able to give that to them or hold it for something else and then gift it.
Yep.
Versus having it be in their name where it is required that it goes to them. Because I've seen back in the day when I was at Merrill, like parents that didn't want to give the money yet, but it was a custodial account that was in their kid's name where they hit the age of majority. I'm like, you don't have the option. Like, this is legally theirs. I'm sorry, you don't have control over it anymore. They didn't like that. And it's like, well, you shouldn't have opened the account. Like, this isn't a smart decision. And to me, I would much rather have it there where you have and can maintain control over it. And then the Roth IRA piece, great. How are they earning income? That's my question. He doesn't talk about that at all. And again, I know it's TikTok and it's quick, but yeah, Roth IRA is great for the kid, should do it, but they have to have some sort of earned income at that point to be able to contribute to it.
Yeah,
So.
then a couple points that on kind of things you mentioned. So I would agree with you. Like, I think from like the oversight on the credit card, it's hard. I would disagree with you on the needing it. Like, it's like one thing. I used to work with a bunch of like college age kids on like kind of finance 101 type stuff. And one of the things I found is it's really hard to build credit when you're in your late teens, early 20s. But what we're starting to see now from like job applications and stuff like for kids coming out of college is credit profiles are actually becoming a required thing to get hired. So I've actually seen kids get turned down for jobs out of college because they had no credit score. So it's like insane with like apartments. So I think building a credit score, whether we like it or not, we're sort of in a debtor society where credit score is super important and something to maintain a healthy credit score. So I think from that standpoint, even if you don't want to do a sort of joint credit card, getting your kid like when they hit 18, getting them a credit card, call it like a $500 starter credit card or whatever, just to buy gas or something, I think is super important. So at least getting your kid onto a credit card, teaching them responsibility with that and helping them build a good credit score by the time they get out of college, I think is super important. And if your kid's not going to college, then you probably want to start earlier. Otherwise they may not be able to get that job or get that apartment. But yeah, again, it all goes back to you can get in a lot of trouble, and I know that from personal experience, and I'm sure a lot of people listening do as well. But on the 529 piece, there's a story I like to tell that kind of shows the downside of 529s. And this may change my opinion. There's actually a thing going through Congress right now to potentially allow you to change a 529 to a Roth IRA.
That would be great.
If you have excess funds. But I had a client back in my days at Schwab where they had essentially, I think it was like $900,000 saved in 529s because they had 3 kids and wanted to pay for all like expensive California schools. Kid number 1, got a full, I think it was a full academic ride. Kid number 2 went to the military and ended up going on the GI Bill. Kid number 3 got a full athletic scholarship. So they didn't have to pay a dime for college and had $900,000 stuck into 529 that they then had to pay taxes on and a penalty to get that money out. And so I think that's one of the the horror stories of the 529 is like, you don't, depending on when you start it, you don't know what kind of student your kid's going to be, you don't know what kind of athlete, you don't even know what college is going to look like 18 years from now. So I think it can be a big trap. Custodial account, 100% agree. I've never seen a custodial account go that well. And also, one thing that people often don't realize is that a custodial account actually counts against you for financial aid for college. It's very painful. So like students' assets make it much harder than parent assets to get financial aid. So if 529 counts as parent assets, a custodial account counts as student assets. And for example, every dollar in there is expected to be used for college, up to 20% that a student has, whereas like a parent's like every 5% of assets. So yeah, not a big fan of those things. The Roth IRA, I think, is a really good strategy for business owners, because basically what's nice if you're a business owner is child labor law rules do not exist. You can hire your kid with earned income at 4 years old to, file papers for you or do, kind of whatever a 4-year-old is capable of doing. And you can pay them $6,000 a year, put it all in a Roth IRA. They have earned income in that Roth IRA that's compounding tax-free. But yeah, for the average Joe, you have to kind of start whether to travel later. I can't remember, is it 14 when you can get your first job? 15, depending on the state?
Yeah,
something like that.
Kids are a little further away from 14, so I haven't looked.
Yeah, me neither. I know I worked illegally as a kid when I started. So.
Yeah, it's all right. Yeah. I think for the most part, like the video's intent is trying to do things the right way, and that is something I like. So with that, let us know what you think of the idea of the kind of TikTok themes. We'll probably do more of these in the future as we see them, and really appreciate you tuning in. Make sure you like, subscribe, all that good stuff, and plug the show. Let us know your thoughts and any feedback, but any closing parting words, Josh?
No, thanks for tuning in. And yeah, we definitely are open to feedback and want to hear what ideas you guys want to hear us chat through, or questions that you have that we could, throw up. That's always great feedback from our end. So yeah, appreciate you tuning in. Until next time, cheers, and all the best.